Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Today is a beautiful Sunday, and we're going to conduct something called Sunday Money Mastery. And you might ask, what is that? And that's just another excuse to study velocity banking. So let's go ahead and start with step one, velocity banking. So we have a spreadsheet, and what is the first two steps of velocity banking? The requirements, we have that here. We say it in every single video. The first requirement is that we need a budget. So we have that right here, right? And actually, let me erase this. I was just practicing with some numbers. But let's assume, okay, that we're this person and we're making really good money. You know, we have two credit cards, an auto loan, a fresh new auto loan, and we'll even say a fresh new mortgage or fresh new refinance, right? $200,000 at 6%. Okay. And make really good money, 6,500, and we have a lot of expenses. I mean, take a look at this, 44K of credit card debt. Okay. And what we're going to do is we're going to pay off these debts to increase our cash flow. And I love seeing numbers like this because even though we don't have that much savings compared to our income, anytime I see lots of income and relatively little savings, just as long as it's positive, I think we're good. I love seeing those scenarios. Just been my experience. Okay, so we have a budget. Now we're gonna differentiate between what we call the average American and what's a person is velocity banking. And the only difference between these two columns, you know what it is? What's your operating account? So for the average American, the operating account is the checking account, and you pay all your bills in a checking account. For someone doing velocity banking, your operating account is, guess what? Your line of credit. Okay, your line of credit. And our objective for today is pay off all this debt, $266,000. And let's just assume that when we refinance, got a brand new loan for $200,000 at 6%, we're able to get a home equity line of credit. So, what's a home equity line of credit? All it is you're providing your home equity as collateral to the bank, so you can kind of get like a credit card on it, right? And so, if you don't know how home equity is, all it is like the estimated sales price. If you're going to put a for sale sign in your front yard, that's the sales price minus the debt. Okay, so let's just assume that we had, a $300,000 sales price, estimated sales price minus a $200,000 mortgage. We have $100,000 equity, and banks like to lend or are willing to lend up to 80% of that, right? So if you just multiply it by zero point 0.8, then, oh, it's giving me an error. Oh, I got to multiply. I just put zero point 0.8. All right. They're willing to lend $80,000 of as a home equity line of credit. Now, let's assume in this example, we got a $50,000 home equity line of credit. So think of this as a credit card, almost like a credit card, kind of based on the value of your home minus your debts. Okay. So now let's just do velocity banking, figure out how we can pay off these debts easily. We always assume two things when doing the velocity banking budget: no savings, right? And same income. If you make more income, that's fantastic. If you make, if you have no savings, why would we have no savings? Okay. Well, the thing is that when we use our line of credit as our main operating account, what we're going to do is put our entire paycheck into that main operating account. And it's going to do two things. One, satisfy the minimum monthly payment, and number two, minimize the interest because the interest that accrues in the line of credit is based on the average daily balance. Okay, so let's go ahead and figure out, re-engineer our finances so we can easily increase some cash flow. So we got ourselves into a jam and decided that we're going to take 44K of debt. I don't know, maybe went crazy. Uh, went on a bunch of Airbnbs traveling. People love traveling, right? And what we're going to do is transfer this $44,000 of debt here to that line of credit. Okay. And what happens when we just transfer debt? This becomes zero. This becomes zero. Okay. Now let's take a look at our expenses and our cash flow. So C2 minus C3. Oh, guess what? This cash flow just increased by making a simple debt transfer. Remember how we started at 1300? Now we're at 2883, which is insane, right? So now what we do, okay, is we're gonna just decrease this, right? So let's just do month one. So we're going to decrease the balance by our cash flow. And if you want to know the formula for the first month, it's I2 plus J2, right, minus our cash flows, 2883.9. Now, even though there's no interest here in the first month, once the first statement comes in, that's month one, you're going to get interest, and then this formula will actually make sense. Now, how do we determine what the interest is? What we do is we take the average daily balance, and you can estimate the average just by using the average function, multiply it by the interest rate, which is zero point 0.1, and then divide it by 12 so you get the monthly interest, right? The 10% is the annual APR, right? And then what we do is we just copy and paste until we see like a red number, right? So if you see, scroll down here, then everything, this is all decreasing based on a cash flow plus the interest. And then you can see it took us 17 months to pay off these two credit cards. 17 months. Oh my goodness. Okay. So let's write some milestones here, right? So now we're going to do this. And then we'll say 17 months, 44K of debt. Okay. Right. So just took 17 months, a little bit over a year, right? And then now what we're going to do is we're going to tackle on this auto debt and the mortgage. So you might think like, which one do I tackle on first? Is it the mortgage or the auto loan? And there's two ways of figuring out the debt payoff criteria of which ones to pay off first. So the traditional like standard model, you look for loans that or debts that fit into these three categories as much as possible: lowest balance, highest interest rate, and highest payment. So this one has the lowest balance, but this one has the highest payment, and they both have the same interest rate. Another way we could figure out is by using something called the cash flow index formula. So it's the statement balance divided by the monthly payment, and let me go ahead and calculate that for all of our debts. Okay. And so we'll just start out with our original credit cards because the difference between the cash flow index for credit cards and loans is that usually it stays the same with credit cards based on it doesn't matter what the balance is because the payment adjusts over time usually, right? Whereas with loans, they definitely do change over time as you keep making payments. But let's just go ahead and do this statement balance 20,000 divided by 700. So you see the 700 payment there, right? And then this one is 24,000 divided by 820. Okay. And then this one is 22,000 divided by 425. And then this one is 200,000 divided by 1191.1. Okay. So, what does this mean? Well, this is I kind of think of it as like a debt payoff ranking. Like the lowest number is the one that you pay off first, and the numbers do have some significance. And I'm just going to go over where I got this from. So this is from the wealthfactory.com, and this is the article about the cash flow index. So it shows this big formula, and right here it says a high number over 100 means the loan is efficient. A low number under 50 means it is inefficient. And so which one has the lowest CFI number is the one you should pay off. It doesn't matter what the interest rate on the loan is. It may seem counterintuitive at first, but results are the only thing that matter. Okay, so again, I'm not going to go too into it, but you could find a better explanation of what I'm talking about here. But based on this, think of it as like a ranking system. And if it's over 100, this is like the one you definitely want to pay off last. Okay, excuse me, coughing a little bit. All right. So let's go ahead and now pay off this auto loan since we paid off these two credit cards. And now we have to figure out 17 months, what's the auto loan balance? So if we have a calculator right here, auto loan calculated by bank rate, we have the amortization schedule, and you could see I kind of have this pre-highlighted. So after 17 months, it should be May of 2025. It should be, although I may make mistakes. So all right. So now what we can do is we can actually recalculate this cash flow index because again, as I said before, in loans it always gets updated, whereas for credit cards it usually does not unless you paid off the credit card significantly. So 39.44, okay? So anything under 50 is inefficient. So let's just go ahead and pay this off, all right? So now what we're going to do at this stage at 17 months transfer 1671 of debt here, okay? And what happens when we do that? Oh my goodness, right? So let's take a look. We did that, and oh, this gets paid off, and this comes to zero. Oh my goodness! And now we somehow went from 1,300 to 3,308. You see, isn't that crazy? All we did by just doing simple debt transfers. Okay, so now what we're gonna do, okay, is let's go ahead and highlight this so that we know this is where we made that debt transfer. And now we're going to basically substitute this with our new cash flow. So instead of 2883.9, it's going to be 3308.9, right? Okay. And so now we're just going to copy and paste this and see when the sucker gets to red. Okay. And now at 22 months, we paid off how much of debt? We paid off 66K, right? So 44 for the two cards and 22 is 66K. Okay, and now we got to tackle on the mortgage. Okay, so now we have this mortgage calculator right here, right? 200,000, 30 years, 6%. And then where are we at the end of 22 months? So we got to look at 22 payments right here, month 22. We're at 195,000. Okay, 195,000. So let's go ahead and do this. Now, at this point, when you have a very inefficient loan, the easiest way to pay it off with Velocity Banking is doing something called chunking. So what you do is just take the 6,500 and then transfer chunks of this to your line of credit and pay it off your cash flow, if that makes sense. So I'll just do a quick demonstration of this and then show you the cheat sheet calculator. So 195,381.96, and let's just say we just do a simple debt transfer. Now this is going to be 18888.96, right? So let's just do that. Oopsie. And then 18881.96, okay? And what we're going to do is just transfer 6,500 from the mortgage to the line of credit, okay? So it'll be right here plus 6,500, right? And look how long it takes us to pay it off, okay? 2 months, 2 months to pay it off. And if you take a look at the bank schedule, right? So if you're at 195, how long does it take you to go to 188 according to the bank schedule? Let's take a look, okay? So 195 is a little bit above the second year mark, and then 188 is a little bit after the fourth year mark. So it's about almost 2 years, right? So what we did in 2 months, it would have taken 2 years in the bank schedule, and we didn't even have to like sweat it, right? And so now we just rinse and repeat again. Now, luckily, because I'm a little bit lazy, I actually have this thing called the Velocity Banking Calculator by Renatus, because I am actually a member of Renatus and I'm independently affiliated, or they call us independent contract marketers, which means that I promote them, I sell their products, and all that good stuff. But I'm not an employee of them. But they have provided this calculator. So if you ever want to get this calculator, you would register for the classes, and I can help you register for them. Okay. So now let's just put in the balance. Okay. So what's the balance of the loan? So this is the original amount. This is the balance, right? So this is the original. All right. And hopefully, let me take the comma off. I think the comma screws things up. And then the balance, the original is 20000. Okay. Let's go down here. What's the interest rate? 6%. Term is 30 years. And the payment amount, let's take a look at the payment amount. I think it's 1199.1. 1199.1. 1199.1. Okay. And oh, I actually screwed up here by $8, but whatever. I'll fix it here. 1199.1. All right, whatever. It won't, I don't think it'll make that huge of a difference for $8, but it might. I don't know. All right. So now what we do is we just put this other right here because our calculator, our cheat sheet calculator, kind of takes into account um, the payment right here, the monthly mortgage payment. And so what we're going to do is we're going to chunk our monthly income 6,500, excuse me, 6,500, And then what we're going to do is chunk the same amount to the line of, whoopsie, I screwed up, 6,500, 10%, and our monthly expenses without the mortgage is 2 grand. Okay, and take a look at that, 4.2 years, right? So 4.2 years is how long it took to pay this off. And if you want to see like kind of like the behind the hood, right? You can kind of see like, oh, like I'm sorry, go back here. The loan balance, the line of credit balance, the daily interest rate. So it goes into all that. Again, I'm pretty sure there's going to be some inaccuracies because of the average daily balance, but it's good enough. So it's saying at 4.2 years, I'm going to pay this thing off, and the interest I pay is like only 26 grand. Okay. So now 4.2 years. So what's 4.2 years in, let's actually do this. 22 divided by 12 is 1.83, and then I'm going to add 4.2, and then we'll see how many years it takes. So 6 years, about 6 years. 6 years to pay 266K of debt. Mind blown. Oh my goodness. Now I'm completely mortgage free. Okay? And it wasn't even that long, right? So I paid it off in, if it was my mortgage, again, it would have taken 4 years, but because I had to pay all these debts off, then it took me a little bit longer. But in total, it took me 6 years, and that's about it. So I don't know what y'all think, but again, it's just another beautiful Sunday session to study money mastery today, velocity banking. Okay? All right, so if you are interested in joining our group, go ahead and click the Google form link below. Other than that, happy Sunday, and this will be the last video for today. And I gotta get to a family reunion soon. So bye everybody.